Hello there, I hope that you're doing well. Welcome to episode 16 of the Zeussy Public 2025 Mentorship here on YouTube. During this lecture, I will be reviewing the Nasdaq. Before we dive into the charts, I first want to share the summary of my reviews of these past few days, which I have outlined before the market delivered. The reason why is because I do not want to talk in hindsight about what happened, but I want to share with you that I anticipated the exact delivery to the tick. So please enjoy the following summary. Moving forward, what I will be monitoring is the following. What I will be monitoring is whether or not we are going to see Nasdaq reprice above this high, whilst ES would also reprice above this high. If that would occur, then I would turn bullish on Nasdaq for the near term, then I would anticipate the market to draw towards this buy-side liquidity pool right here. But again, keep in mind I must see both Nasdaq as ES move in tandem above the previous week's high. If we are, however, going to just slam through this high and begin expanding towards the upside, then to me the 20,500 price level comes to mind as an initial draw on liquidity, and we're just going to play it level by level then. The reason why is because when we pay attention to the delivery on the left, which I'm going to showcase to you, what I want you to see is that this is the PM session low of yesterday, yes, and therefore that's a key time-based liquidity pool based on the sessions, and therefore that's a sell-side liquidity pool, which I'm monitoring the reaction to. Here on the daily chart of Nasdaq, and what you can see is that Nasdaq opened up this week and immediately expanded towards the upside. The weekly open can be seen by this orange line right here. Notice that when we opened up this week, we saw a gap get created between Friday's close and Sunday's open. This range is referred to as the new week opening gap. When you see the market expand higher from the new week open, whilst you have a bullish bias for the near term, you can anticipate that we're likely going to see very big green candles towards those objectives. What you can see is that on Monday we saw the market expand towards the upside, drawing towards the buy-side liquidity of the previous week's high, which was right here. When this previous week's high was taken out on both Nasdaq as ES, what happened was that an S&P which was present relative to these highs right here got invalidated. And as you heard me outline during my weekend review, you heard me outline that when that S&P would get invalidated by both markets trading above that previous week's high at the same time, that would mean that we would likely see the markets be repriced towards the upside. What was the first buy-side liquidity pool objective? Well, the first buy-side liquidity pool objective was a previous week's high, meaning this was the previous week's high, but the high of the week prior was right here. So that is how I'm using time cycles logic to determine my draws on liquidity. And also the levels where I can anticipate significant reactions of. Notice that we see the market reprice above this weekly high on Monday, and we then saw the market open low on Tuesday. On Tuesday you heard me outline that I was expecting further continuation higher taking place. What was the level I was anticipating the market to draw towards? I anticipated the market to draw towards the price level of 20,500. When we pay attention to how the market reacted off this level, you can see that we just went above it by a few points before the market eventually formed a swing high and began drawing towards the price range of that new week opening gap again. What I would like you to see here is that on the lower time frames, you could have bought Nasdaq throughout this run higher, and you could have sold Nasdaq throughout this run lower. Inception, weekly open, to terminus. Terminus turns into inception of a new price swing towards a new terminus. A to B. B turns into A, and a new A to B gets established. What is the new B? The new B is the new week opening gap. And what I just outlined probably is too advanced for the majority of you. But I would like you to understand that every single price swing has a specific inception point, where the price swing originates from. Your job is to recognize where these inception points are, because once you recognize that a specific buy or sell program is in play, you can anticipate the next delivery with a great deal of precision, as you can see me outline throughout my reviews. When we pay attention to the hourly chart then, what you can see is that I've annotated a lot on this hourly chart, and I'm going to walk you through each annotation step by step. First of all, I would like you to understand that this new week open gap right here got established the moment that we opened on Sunday, and there was a difference relative to Friday's close. Notice that when this new week opening gap took place, we saw the market just continue expanding towards the upside. Monday opens up and we open low, and we then see the market expand through the previous week's higher price level. What is that price level? The price level is this horizontal line right here. Do you see how the sequence of imbalances got created whilst the market repriced through that high? That's a key algorithmic signature, because that shows to you that at one moment in time, we must revisit those imbalances to balance out this price range. And that's the key insight which I want to share with you, because once you start paying attention to how time cycles, their respective highs and lows, are getting displaced through, you begin to understand that there's a certain sequence when it comes to how price is displacing through these levels and what will happen next. What you can see is that the market continues expanding higher, and there's a rush for the market to reprice higher. What is it drawn towards? It is drawn towards that weekly high, its price level, which is right here. That means that on Monday, I'm looking for one thing. I'm looking for open, low, until that price level gets met. Meaning, throughout both London as the New York morning session, you could have been looking for buying opportunities. Eventually, we see the market consolidate around that price level, and notice that I've annotated the PM high and the PM low of this day moving forward. As you saw me outline throughout my Tuesday market review, I outlined that I would be monitoring the reaction to the PM low right here. Notice that on Tuesday we initially ran up higher, and we then saw the market drop towards the downside, taking out sell-side liquidity resting below that PM low which I was monitoring. You might be wondering, why is that PM session low important? Well, that PM session low is important because throughout the London session, you refer to the high and low of the Asia session and the high and low of the afternoon session. Meaning you're looking back at how the previous sessions delivered, and you're looking at key liquidity pools that are time-based. Next, that what is important to note is that what we saw taking place was that the market expanded higher. There was a rush for the market to be repriced higher. It was drawn towards that weekly high of this buy-side liquidity pool. And once this level was taken out, we saw consolidation taking place. And if there's one insight which I would like to share with you is the following. A reversal never occurs from a consolidation. Meaning we must see the market manipulate towards the upside. If you pair this logic with the understanding of the market having to reach this 20,500 price level, you must understand that until that level gets met, we're looking at one thing, and that is open low, meaning we're looking for fractal market maker buy models to present themselves on the lower time frames. Notice that we see the market expand higher throughout the London session right here, and a retracement then takes place. Notice that the market retraces into an imbalance which got created right here, and we'll get back to this imbalance in a bit because it's a very important imbalance. We then see the market expand higher one more time throughout the morning session, and notice that the market stops right in advance of that 20,500 price level. Well guys, if I see the market stop right in advance of a price level which I had already outlined to be my draw liquidity before the market even came close to that level, I know that we're likely going to retrace, to trap sellers into believing the high is in, retrace into a key level. What is the key level? This PM session high. Form a low there and then expand towards the upside. Why? Because buy-side liquidity was engineered above this high, and therefore the moment that the market reprices above this high, I'm monitoring the reaction to this high in particular. Notice that this high was taken out at exactly 4 PM right here. Meaning at 4 PM we did not only take out that high, but we also reached that price level of 20,500. We then see the market spend some time above that level, and eventually the market displays towards the downside. Time distortion takes place inside this bearish breaker, where I can see that the market is just consolidating. It's going back and forth, back and forth, back and forth. The market is waiting for the right time for that to begin spooling towards the downside. 9:30 AM comes along on Wednesday, and what do you notice? What you notice is that we immediately reprice through the price range of this bearish breaker right here. Why is this a bearish breaker? Well, we see a high, low, higher high, and therefore the moment that we displace through this low, this becomes a bearish breaker. We'll dive into this in the lower time frames in a bit. What you can see is that the market expands very aggressively throughout this 9 o'clock RE candle. Notice that the market reprices lower through the price range of that imbalance which I had outlined right here. Notice that we see the market close aggressively below that, And therefore, what I'm monitoring is the following. I'm monitoring whether or not this imbalance is going to function as resistance on price. Because when you pay attention to where we stopped for this 9 AM RE candle, you can see that we stopped right in advance of the previous day low. Therefore, what I'm expecting for the next RE candle is open high. Where should the high form? The high should form inside the price range of that BC right here. Why? Because this BC, this bullish fair value gap, should now function as an inversion value gap in the future. That's also the reason why this large CB right here was allowed to be left intact. This large CB functioned as a breakaway gap. Why? Because the price range was already balanced, and therefore IPTA is allowed to spoot lower. And that shows to you that the very bearish day is in the making. Why? Because on any normal day, so to say, where there wouldn't be a rush for the market to reprice towards the downside, we would have seen a deep retracement taking place, and then the market would have expanded lower, right? That's your classical ICT market structure. However, on a day where there's a rush for the market to be repriced towards specific levels, in this case, that new week opening gap, what you will see is that imbalances will be allowed to be left intact. Why? Because they will function as breakaway gaps, and when you see this, boy oh boy, you know that you're in for a ride that day, because that shows you that there's an urgency for the market to reprice higher. We slam towards the downside and the market continues expanding lower. What is the first draw on liquidity when this run lower takes place? Well, first of all, we refer to that previous day low as the key sales liquidity pool. After that, the level which we can refer to is the following. The level which we can refer to is that previous week's high price level, this level right here. But notice that we can look at that range around that level and you can see that sequence of imbalances. Notice that I'm plotting that whole sequence of imbalances from low to high. Therefore, that's a very important range to monitor. And that is a range which I'm extending to the right as well, as you can see. Meaning, first draw on liquidity previous day low, second draw on liquidity sequence of imbalances, third draw on liquidity for the afternoon session, new week opening gap right here. Isn't it beautiful how the market expanded towards the upside to begin the week, and then on Wednesday it immediately began drawing towards the downside, drawing towards the weekly open. What I would like you to see is how the left side of the curve influenced the right side of the curve. Pay attention, for example, to that sequence of imbalances, right? Do you see how the market displaced through that sequence of imbalances, retraced higher, found resistance inside that sequence of imbalances, and then repriced towards the downside, drawing towards that weekly open right here? That shows to you that you can utilize these imbalances on the left side of the curve to anticipate when and where swing points are likely going to form on the right side of the curve. If you don't believe me, pay attention to when this high formed and look to the left. Moving forward on Nasdaq, what I will be monitoring is the reaction to the sequence of imbalances. Personally, I will not be trading anymore the remainder of this week, and the reason why is because from Monday to Wednesday I took phenomenal trades and I'm more than content with that. Therefore, I'm not going to be looking at the markets from a trading perspective, but if I would look at them and I would have to share my analysis with you, what I would be monitoring is the following. What I would be monitoring is this sequence of imbalances. I would extend that to the right. And as long as the market does not displace above this sequence of imbalances, I would favor another run towards the downside. Sales liquidity pool is resting below this low right here. And if we would manage to displace below that new week opening gap, utilize it as resistance on price, well, to me, the sales liquidity of the previous week comes to mind then as a draw on liquidity. If Nasdaq would displace above this sequence of imbalances, utilize it as support on price. I anticipate that Nasdaq is likely going to go back and forth between the price ranges of these two imbalances, these two blue shaded areas right here, which I've annotated on my chart, meaning this imbalance and this sequence of imbalances right here. And that's my analysis moving forward on Nasdaq. Now, what I would like to do with you is I would like to pay attention to the delivery which took place during both the morning as the afternoon session. What I would like you to see is that throughout the morning session, we saw this huge 9 AM RE candle slam towards the downside. It looks like the market just expanded lower and that was it, right? However, on the lower time frames, you must understand that there are a lot of opportunities utilizing these arrays of, for example, this bearish breaker and this imbalance. Meaning, shorting opportunities presented itself from this bearish breaker to this imbalance. New shorting opportunities presented itself from this imbalance, from this inversion of the value gap to the previous day low. Let's take a look at the lower time frames. First of all, we're going to be paying attention to the morning session. What I would like you to see is that we expanded throughout the 9:45 to 10:15 macro below the price range of that bearish breaker from the RE chart, that red shaded box. Notice that we saw the market displace through there, and we then saw a retracement taking place. Do you see how the market rejects that price range perfectly? The moment I see this rejection taking place, I'm looking at a seconds chart to confirm to me, alright, we're in fact in a sell program now, and we're going to see further continuation lower. Meaning what I'm looking for is I'm looking for shorting opportunities between those two higher time frame arrays. Bearish breaker, imbalance. Notice that I was in and out of the position within just a matter of minutes right here. Market expanded beautifully towards that objective of that imbalance, and we then saw the market slam through it, meaning we saw a displace through that imbalance. Do you see how through the price range of that RE imbalance, this CB got created? When I then see a retracement taking place into that CB, I'm shorting off that range. Why? Because I'm shorting not only inside of this CB from the 1 minute chart, I'm also shorting inside of the price range from that RE imbalance, which should function as an inversion of the value gap. Market expands beautifully towards the downside, and it's drawn towards that previous day low right here, and eventually it goes beyond it. The market then retraced deeply, and it spent time around the previous day low for a while, and it then had one more push lower before running up higher. My trailed stop got hit, and looking back at the delivery which followed afterwards, I could argue, oh, I trailed my stop too tight, or, I could have held onto my runner for longer, etc. But looking back at this delivery, I am happy with the trade management, and I'm happy with the fact that my runner got hit right here. Beautiful trades during the morning session, all within the framework outlined of that RE chart. And that is a key takeaway which I want to share with you. You need to be able to frame these price swings based on the RE chart. If you're unable to see it on the RE chart, you have absolutely no business dropping into the lower time frames. Look, even though you see me execute on the 1 minute chart or even on the 15 second or maybe even 5 second chart, right? You must understand that I'm working within a higher time frame premise. I'm not simply looking at those lower time frames and trading based upon those. No, that's foolishness. What I'm doing is I'm framing my setups based upon the higher time frames. And when I can see it on the higher time frames, I can drop into the lower time frames and trade based upon them. When we pay attention to the afternoon session then, what you can see is that a shorting opportunity presented itself. This shorting opportunity presented itself from that sequence of hourly imbalances, because that's this blue shaded box. Remember how we outlined that the new week opening gap was the draw liquidity? What you can see is that we saw the market stop right here in advance of that new week opening gap. The market consolidated. We then saw it begin to run towards the upside, meaning we saw it begin to run towards the upside and it's slowly gravitating towards the upside. Notice that we then saw a new 30-minute and 90-minute cycle open up at 2:30 p.m. Open, high, S&P detector signals S&P with ES right here, and we then saw the market displace towards the downside. We see the Zeussy market structure shift pattern taking place, where we can see that the market creates a CB right here through this low, through a low which formed inside of a BC. Retracement takes place, IOFED, institutional order flow entry drill, went short inside of that CB, and then participated in the sell program towards the downside. Eventually the market just continued ripping, and it delivered towards the weekly open in advance of 3 p.m. Beautiful sell program, and what you can see is that I've utilized those arrays which were based on the hourly chart to frame this delivery. With that being said, this actually comes to an end. I hope that you found it insightful. I want to wish you a nice remainder of your week, and we'll speak soon again, Lord willing. Be safe.